Welcome to the Deep Dive brought to you by Finbot Insights. Today, we're embarking on quite a meticulous examination. We're looking at the prevailing attitudes towards wealth creation and investment. And this is particularly for you, our retail income investors who are, keenly focused on enhancing your financial future. Our mission here is to delve into some critical perspectives on traditional investment choices. We'll be drawing specifically from insightful excerpts within the recent research document. And we want to illuminate some powerful, often overlooked alternatives. We're really going to unpack why that conventional wisdom regarding safe investments, while it might inadvertently hinder your long-term wealth accumulation. And we'll explore strategic approaches designed to mitigate risk while simultaneously pursuing substantial returns.
Indeed. Our objective for this deep dive is really to extract pivotal insights and actionable knowledge from these sources. This information is intended to empower you to navigate the complexities of the investment landscape with hopefully greater confidence, ensuring you are thoroughly well informed as you make your financial decisions. We really aim to clarify common misconceptions and highlight pathways to genuine financial growth that frankly extend beyond the conventional.
Okay, so let's unpack this. Let's begin by examining the very foundation of the stock market itself. At its core, the stock market was originally conceived, designed as a robust mechanism specifically for wealth creation. Its foundational purpose was, and well, still is, to serve as a vital conduit for entrepreneurs, enabling them to transform their innovative ideas into thriving businesses. And this fundamental function, in turn, profoundly benefits the broader economy. It's presented within our core analysis as a vital, indeed a thriving engine that propels economies globally, fostering innovation, creating employment, distributing prosperity, both directly and indirectly. What's truly fascinating here is its intrinsic value.
Yes, what is truly fascinating here is that the intrinsic value of the stock market lies precisely in this capacity. It really does. It stands as a testament to collective human ingenuity and enterprise.
Yeah.
In my informed view, and as consistently reinforced by historical data and the source material we're reviewing today, it remains the optimal method for achieving genuine returns that consistently surpass inflation. Unlike other avenues for capital deployment, the stock market offers a tangible stake in the productive capacity of businesses. This ownership, however small it might seem, grants you a proportional claim on future earnings and growth. And historically, this has proven to be the most reliable and, frankly, efficient way to grow capital beyond the erosive silent impact of rising prices.
Right, despite this foundational strength and, as you said, proven historical efficacy, recent historical events have significantly shaped public perception, haven't they? We've observed considerable skepticism and at times, outright derision directed towards the stock market. This sentiment largely stems from the profound economic struggles that emerged during specific periods, notably the 2008 global financial crisis and, more recently, the sharp economic contraction triggered by the COVID-19 pandemic in 2020. These periods generated widespread unease and significant financial anxiety among individual investors, and, well, understandably so.
Oh, absolutely. The 2008 recession in particular had a truly detrimental and deeply felt impact on individual retirement accounts across the nation. Millions of Americans, through no fault of their own, witnessed the value of their 401k funds, and individual retirement accounts devalued by nearly 50%, almost half. This wasn't just a minor dip. For many, it represented years, even decades, of diligent savings seemingly vanishing overnight. This experience instilled a pervasive fear and a profound wariness within the investment market. It created a strong psychological aversion to market participation. Unfortunately, this fear often compelled individual investors to withdraw funds from their retirement plans and IRAs at precisely the wrong moment during the market's nadir, its lowest point. This action, while emotionally driven by a desire for safety, paradoxically exacerbated the financial downturn. It removed critical capital from the market and further depressed asset prices. It created a kind of self-reinforcing cycle where fear fueled further decline, solidifying a narrative of the stock market as inherently risky and, well, unreliable.
So what does this all mean for us today, especially for those considering how to approach their investments now? The analysis we're performing reinforces a crucial truth. The stock market is inherently cyclical. It's not a static entity. It fundamentally rises and falls over time. This cyclical nature isn't a flaw in its design, but rather of a fundamental characteristic of a dynamic, ever-evolving economic system. It mirrors the ebb and flow of business cycles, technological innovation, geopolitical shifts, all of it.
And this raises a profoundly important point for investors to internalize, doesn't it? A critical principle emerges from observing these historical cycles. Investors should never permit the fear of fluctuating stock prices to compel them to withdraw cash during market downturns. Doing so, as we've seen time and again, can lead to significant missed opportunities for recovery and subsequent growth as the market inevitably rebounds. The impulse to get out when things are down is entirely understandable, of course. It's driven by a primal urge to protect capital. However, this often locks in losses, preventing you from participating in the eventual, almost certain, upswing. The market's recovery, though not always immediate, has historically always occurred. It finds its way back.
Okay, moving beyond the stock market and its perceived volatility. Let's turn our attention now to fixed income investments. There's a common inclination among investors, particularly those who perceive the stock market as excessively risky, towards options like certificates of deposit, CDs, and traditional savings accounts. This preference is particularly strong for individuals seeking what feels like a more secure harbor for their hard-earned capital, prioritizing nominal safety above all else.
It's entirely true. There is an intuitive, almost comforting appeal to liquidating holdings during market dips, especially when volatility feels overwhelming and headlines are, dire. However, if we connect this immediate comfort to the bigger picture of long-term wealth creation, the efficacy of such actions is consistently challenged by the historical data. It just doesn't hold up. While the perceived safety of these fixed income options offers immediate psychological solace, maybe, their actual benefit over time is often illusory when viewed through the lens of true wealth growth and critically purchasing power preservation. The danger lies in mistaking that nominal stability for real financial progress.
Yeah, our analysis uses a powerful and, I think, highly illustrative metaphor for holding cash in low-yield accounts. It's akin to keeping your money under your mattress. This approach, it meticulously explains, simply does not yield benefits in the long run. In fact, it often results in a quiet but persistent erosion of wealth, a financial diminishment that many investors may not even perceive until it's, too late. It's like a slow, silent thief.
This is a crucial point that demands meticulous explanation, I think, as it underpins so many misconceptions about safety. Cash, by its very nature, declines in real value due to inflation. It just does. Imagine your $100 from today, capable of buying, say, a full tank of gas or a week's worth of groceries. If you simply keep that $100 in a low-yield savings account, or literally under your mattress for 10 years, even though it remains nominally $100, inflation could mean it now only buys you half a tank of gas or half a week's groceries. Maybe less. It's like that silent thief, constantly eroding your purchasing power without you ever seeing a single dollar disappear from your account balance. Furthermore, by opting for these low-yield fixed income accounts, investors forgo the dividends and capital appreciation they would have received had they maintained their stock investments. When we meticulously examine historical data, it's abundantly clear that the yields on fixed investments consistently render significantly lower returns compared to stock investments. This isn't merely a minor difference, it represents a fundamental divergence in long-term financial outcomes, costing investors vast sums over decades.
Let's look at some illustrative examples from the analysis to make this concept really concrete. The Good to Know section within our source material highlights that most CD and savings accounts offer extremely low interest rates, which at best barely manage to keep pace with inflation. This is a critical detail for you, our retail income investors, to grasp as it directly impacts your future financial standing.
Absolutely. For instance, if you look back to August 2018, a 5-year CD yield topped out at a mere 2.0%. As we've just discussed, historically speaking, that rate is barely sufficient to cover the rate of inflation, if that. To visualize this more clearly, consider a hypothetical $5,000 investment placed into a CD over a 5-year term. At the end of that period, you'd be fortunate if that money retained its nominal value, but its real purchasing power would almost certainly be diminished once adjusted for inflation. It's a scenario where you keep your principal, sure, but its actual buying power quietly slips away. And the analysis further highlights that CD interest rates have consistently declined year after year, offering less and less protection against those erosive forces of inflation.
That is indeed a powerful visual, demonstrating a subtle yet significant loss, isn't it? Even if you were to invest a larger amount upfront in a CD or online savings account, say maximizing 1.8 to 2.0% for a shorter period, the outcome could be surprisingly similar in terms of real returns. If you locked away your cash in a CD, upon withdrawal, the principal and the minimal interest earned could still be worth less than the original purchasing power of your principal due to the relentless march of inflation. That's a fundamental truth often overlooked by those solely focused on the nominal figure, that number on the statement.
And Figure 1 from the source vividly illustrates this critical point. It really does. It graphically demonstrates how the rate of return for CDs has been steadily decreasing over the years. Crucially, it also shows how, in recent times, these rates often fail to even meet the rate of inflation, creating a guaranteed loss of purchasing power over time. It's baked in. A stark example provided is a $100,000 investment placed into a CD in 2017. Which, over a 6-month period, yielded only $408 in interest. $408. Now, juxtapose that with a diversified investment account over the same 6-month period. Such an account could, on the lower end, have experienced a return of 7%, maybe, translating to a profit of $3,500. That's considerably more than your $408 from a CD rate. And this larger amount, of course, can increase exponentially through the power of compounding as you maintain your investments over a longer time horizon. It truly underscores the profound opportunity cost of choosing perceived nominal safety over actual tangible wealth growth.
So if fixed income investments often lead to an erosion of purchasing power, sometimes even a diminishment of real wealth, how do we genuinely create wealth? How do we actually move the needle? The analysis points unequivocally to unlocking genuine wealth creation through equity investment, specifically emphasizing the superior potential of intelligently constructed, diversified portfolios. This contrasts sharply with the limited, often negative real returns of fixed income options.
Precisely. A meticulously constructed, diversified investment portfolio, comprising individual stocks, exchange-traded funds or ETFs, and mutual funds. It offers the potential for significantly superior returns. Let's just briefly elaborate on those. An exchange-traded fund, or ETF, and a mutual fund. They're essentially professionally managed, pre-packaged baskets of investments, like a ready-made meal for your portfolio. Instead of you having to research and buy individual shares of, say, 20 or maybe even 200 different companies, you buy one unit of an ETF or mutual fund, and that single unit gives you a tiny piece of all those companies. It's an incredibly efficient way to gain instant diversification, spreading your risk across many different assets without having to research each one individually. Such a portfolio enables investors not just to keep pace with inflation, but genuinely to overcome it and create substantial, enduring wealth. And the benefit is further magnified by the unparalleled power of compounding, which works over time at a much higher rate of return within such investment portfolios compared to lower-yielding alternatives, where its effect is, well, almost negligible.
However, we absolutely must acknowledge the inherent volatility of markets. That's fundamental. This is a characteristic, not an anomaly. Investments can certainly decline over a short period, perhaps a 6-month span, only to potentially recover and even rise significantly in the subsequent 6 months or over a longer period. This fluctuation is a reality of equity investing, and it's crucial to manage our expectations accordingly. Don't expect a straight line up.
Right, and this raises a critical question about how to navigate this inherent market volatility without succumbing to fear. The strategic advantage lies squarely in investing for a longer duration, a longer time horizon. This approach provides ample time for the recovery of any temporary portfolio losses, and crucially facilitates the achievement of a much higher rate of return over time. This is particularly effective through a widely utilized technique known as dollar cost averaging. Now, dollar cost averaging, for those unfamiliar, is a methodical approach of systematically investing equal amounts of money at regular intervals, maybe weekly, bi-weekly, monthly, whatever fits your budget, irrespective of the stock price at the time of purchase. Think of it this way. Instead of attempting to guess the absolute bottom of a market, which, let's be honest, almost no one can do consistently or reliably, dollar cost averaging automates your buying. It takes the emotion out. When prices are high, your fixed investment buys fewer shares. Makes sense. When prices dip, that same fixed amount buys more shares. So over time, you effectively average out your purchase price, smoothing out the roller coaster of market volatility, and often building a larger share count that can significantly appreciate when the market eventually recovers. It's a disciplined, unemotional approach to investing. Very powerful.
And this brings us to a powerful and profoundly simple concept, the principle of patience and ownership. The analysis asserts that remaining steadfast when the market dips, resisting that impulse to panic sell, and maintaining your investment portfolio during downturns can lead to truly substantial long-term gains. It's fundamentally about resisting the urge to react to short-term noise and temporary headlines, and instead focusing on the underlying value, the quality of what you own.
What's particularly compelling here is the illustrative example of Warren Buffett, one of the world's wealthiest individuals who has amassed immense fortune primarily through the virtue of patience. Just holding on. His strategy is remarkably straightforward, almost disarmingly so, consistently acquiring shares in high-quality, well-managed businesses at a fair price, and then holding them indefinitely, basically forever. This unwavering commitment to long-term ownership isn't merely a preference, it's a cornerstone of his success and a profound lesson for all investors. The market is littered with the ghosts of investors who chase the next hot stock, hoping for a 10x return overnight, quick riches. What separates the consistently wealthy from the occasional gambler is the disciplined pursuit of singles and doubles, steady, reliable growth. It's far less exciting for the headlines, maybe, but profoundly more effective for your long-term balance sheet.
Right. And while many so-called experts and market pundits have debated this seemingly simple approach, advocating for more complex or active trading strategies, the demonstrable results of this patient, long-term philosophy, as the analysis points out, well, they speak for themselves, don't they? It's exceedingly difficult to argue with that kind of consistent compounding success over decades.
Indeed. What's crucial to understand is that for Buffett and for other successful investors who truly wish to grow their wealth sustainably, owning stocks transcends the mere analysis of analytics, charts, or fleeting financial data releases. It's more than numbers on a screen. Instead, it fundamentally embodies a deep sense of ownership. It represents having a genuine interest and pride in possessing a portion of a well-run business. That is expected to deliver both present and future profits, albeit with the acceptance of occasional temporary losses. That's part of the deal. This approach signifies a steadfast, long-term commitment to endure volatility and maintain trust in management's ability to navigate the periodic challenges or headwinds that inevitably arise. It's a partnership with a business, really not a fleeting transaction based on short-term price movements. It requires a profound psychological shift from a trader's mentality to an owner's mentality.
Now let's transition to a more practical aspect of investing, moving from the philosophical to the actionable. The backstory element from the analysis provides a valuable perspective, I think, noting that the investing strategies presented were uncovered through a process of trial and error, involving numerous early career mistakes made by the authors themselves. This personal journey, fraught with practical lessons, lends significant weight and credibility to the advice now being offered. They learn the hard way.
Yes, and this raises an important question. What is the core philosophy that emerged from that invaluable experience, from those mistakes? The emphasis is unequivocally on simplicity, unwavering adherence to a rules-based approach, and the crucial understanding that simple does not imply inferiority or lack of sophistication. Not at all. On the contrary, simplicity often indicates robustness, something that works reliably. It means keeping your head down and staying true to your principles, essentially. A disciplined approach that focuses on what truly matters and avoids unnecessary complexity or, importantly, emotional reactions to market noise. This is about building a repeatable, consistent process for yourself.
Okay, so what specific characteristics should you, our retail income investors, meticulously look for in companies deemed suitable for investment? The analysis enumerates key criteria that form the bedrock of a sound investment decision. Companies with robust balance sheets, solid fundamental business models, highly effective management teams, superior products or services, and resilient, robust supply chains. That's quite a list.
It is, and to expand on these essential criteria, it's also paramount to identify companies that possess the inherent ability to increase their prices during inflationary periods without losing significant market share. That pricing power is key, effectively maintaining their profit margins and real earnings power. Furthermore, they should demonstrate exceptional agility and resilience in navigating recessionary periods. This agility is typically a direct byproduct of strong visionary management and the presence of ample free cash flow on hand. Having cash gives you options. When we look for companies with great balance sheets and solid fundamentals, what are we really checking? We're essentially checking their financial health and stability. A balance sheet is like a snapshot, right? Everything a company owns its assets versus everything it owes its liabilities. Fundamentals delve into how profitable and stable the business is at its core. Are their sales consistently growing? Are they consistently generating good profits? Do they have cash flowing into the business that they can use for reinvestment or dividends? And critically, do they maintain minimal manageable debt? These are the underlying strengths that predict long-term success and resilience through various economic cycles.
Right. And beyond these foundational characteristics, the strategy meticulously described involves seeking companies that consistently increase their earnings over time. This consistent growth and profitability is a key undeniable indicator of a healthy, expanding, and well-managed business. It shows the company isn't just surviving, it's thriving and growing its intrinsic value.
And what's particularly fascinating here, especially for our income-focused listeners, is the additional, highly important criterion of identifying companies that consistently augment their dividends. They raise them year after year. This isn't merely a generous gesture. Such dividend increases are financially supported by sustained earnings growth. They have to earn it first. This creates a virtuous and self-reinforcing cycle. In general, you'll consistently observe that a general appreciation in stock prices often accompanies these very characteristics. They tend to go hand in hand. The true measure of investing success, as defined by this methodical approach, is consistently producing solid, reliable returns rather than attempting to achieve isolated home runs that are often more about luck than skill. Forget swinging for the fences every time. This disciplined, rules-based method has successfully enriched countless professional and retail investors over time. It's not about trying to reinvent the wheel or discover some secret formula. It's about diligently applying proven, sound financial principles.
Okay, let's try to quantify portfolio growth a bit, just to underscore the sheer power of these carefully applied strategies. The analysis introduces compelling hypothetical examples of diversified portfolio growth over a 10-year period, commencing with an initial investment of $100,000. These examples are quite compelling in illustrating the potential financial divergence, the different paths your money can take.
They certainly are. Across various portfolio allocations, the rate of return in these hypotheticals is significantly higher than anything achievable in fixed income instruments. It's not even close. Such portfolios could generate additional earnings of approximately $60,000 to $90,000 on that initial $100,000 investment over just a decade. This profoundly underscores the immense financial advantage of making more substantial returns on your investments, compared to the negligible or even negative real yield seen in fixed income options. It's about maximizing the efficiency and productive capacity of your capital over time, turning your money into a tireless worker for you.
And this brings us to the truly staggering power of compounding over time, often referred to as the eighth wonder of the world, right? Consider a compelling hypothetical scenario from the analysis. Investing for just 10 years could yield a profit exceeding $60,000 at a 5% rate of return, or a truly remarkable more than $150,000 at a 10% rate of return. These are not minor differences at all.
No, and the difference this creates is truly staggering, especially when we extend that timeline to 20 or even 30 years. That's where it really takes off. In one remarkable hypothetical example provided in the analysis, even without contributing any additional funds to the account beyond the initial investment, an investor could accumulate over $1.7 million in retirement savings after 30 years simply by consistently earning a higher rate of return on their capital, just letting it work. This highlights a critical principle that cannot be overstated. The faster your money grows through smart investment, the more you'll have available for retirement or even for earlier retirement planning, granting you profound financial freedom and flexibility down the road. With the unparalleled exponential power of compounding, time is unequivocally and profoundly on the investor's side. It's a mathematical force that quietly but powerfully builds immense wealth for those who are patient and disciplined enough to let it work.
So, having outlined the clear benefits of equity investment, we're presented with a fundamental question. A core investor's dilemma, really. Do we prioritize perceived safety? And in doing so, effectively forego substantial potential earnings? Or do we accept some degree of managed risk for the opportunity to earn significantly more money and truly grow our wealth? What's the trade-off?
The choice, as the analysis emphatically states, is unequivocally clear for those seeking genuine wealth growth. It really is. Investing is demonstrably the superior choice in terms of growing your wealth over time. When you invest, you're essentially acquiring a piece of a company or companies, with the fundamental, reasonable expectation that you'll receive a return greater than your initial outlay. You expect more back than you put in. In the context of stocks, this involves either providing capital directly to a company during its IPO, maybe, or purchasing shares on the open market in exchange for a small but meaningful ownership stake in that enterprise. This ownership is the fundamental key to participating in its future growth, profitability, and crucially for income investors, its dividend distributions.
Okay, but if the benefits of investing are so clear and compelling, why then is widespread confident participation in equity markets not observed among a larger segment of the population? What holds people back? The analysis suggests the primary reason is that investments inherently come with perceived risks, and that risk, particularly market volatility, can be genuinely intimidating for many. Feels scary.
Yes, and this raises an important question. How do we critically rethink our reaction to risk, our emotional response? It becomes paramount for successful long-term investing. As we've seen in the examples provided in this deep dive, relying solely on safe investments like CDs or traditional savings accounts results in negligible or even negative real returns. Your money loses buying power. While your principal may indeed remain nominally intact, the number looks the same, it critically fails to grow sufficiently to keep pace with inflation for future value. Consequently, your purchasing power by the time your CD matures or your savings accumulate could actually be less than what you started with in real terms. You can buy less stuff. The core dilemma, therefore, is reiterated. Do you keep your money in investments like CDs where there's no appreciable real return, guaranteeing a slow erosion of purchasing power? Or do you invest in vehicles with significantly greater potential return that bear the inherent but manageable risks of short or long-term fluctuations in the market? For the average investor, it's entirely normal to feel caught between a low-return rock and a higher-risk hard place, perceiving no truly appealing option.
This then poses a rhetorical, yet incredibly pertinent question, doesn't it? Are these truly the only available choices for you, the average investor keenly seeking to grow your wealth? Is it really just a binary decision between financial stagnation and high-stakes gambling? That feels like a false dilemma.
Fortunately, the analysis confidently asserts that they are not. Definitely not. This unequivocally signals the introduction of more sophisticated yet eminently accessible strategies that offer viable pathways beyond that traditional limiting dilemma. These are intelligent choices specifically designed to help you navigate this space more effectively, striking a crucial balance between managing risk and pursuing substantial returns, particularly for those, like many of you listening, with an income focus.
Okay, so the analysis then introduces two key investing strategies that allow for the potential of substantial rates of return, while keeping risk to a minimum, or at least managing it effectively. These are particularly relevant for you, our retail income investors, who are looking not just for growth, but also for consistent, regular cash flow from your investments. Income now.
Yes, and what's particularly fascinating here are these specific actionable methods. First, there's the strategy of writing covered calls on high-quality blue-chip stocks. Okay, let's demystify this a bit. Imagine you own 100 shares of a well-established, financially sound company, often called a blue-chip stock, that you believe will hold its value or maybe rise slowly and steadily. You're not expecting fireworks. You can write a covered call by selling someone else the right but not the obligation to buy your shares from you at a specific predetermined price known as the strike price, on or before a certain date in the future. Now, for granting them this right, you immediately receive a cash payment known as a premium. This premium is income you keep right away, upfront, no matter what happens next. If the stock price stays below your strike price by the expiration date, the option expires worthless. You keep your shares, and you keep the premium you collected. Win-win, kind of. You can then potentially sell another call option on the same shares, repeating the income generation process. Now, if the stock price does rise significantly above your strike price, your shares might be called away. This means you sell them at the agreed-upon strike price. While you might miss out on some extreme upside beyond that strike price, that's true. You've already collected the premium, generating income even as you realize your stock gains up to that strike price. It's a powerful way to generate consistent income from stocks you already own, adding another layer, another stream, to your total returns. Second, and perhaps more widely understood, is generating consistent income through dividends. Pretty straightforward. This involves simply retaining ownership of stocks that regularly distribute a portion of their profits to shareholders. Many strong, established companies consistently pay and even increase their dividends over time, often becoming what are known as dividend aristocrats or dividend champions. These are companies with long track records. These companies, by their nature, tend to be more stable and mature businesses. For an income investor, these regular cash payments provide a consistent stream of income, regardless of short-term market fluctuations. That check arrives in the mail, so to speak. Furthermore, these dividends can be reinvested automatically, often to purchase more shares, which then generate even more dividends, powerfully supercharging the compounding effect over the long term. Both of these strategies, covered calls and dividends, are presented as highly viable choices for investors seeking both robust growth and regular income. Moving definitively beyond the simple and limiting stock market up-down narrative, they offer a much more nuanced approach to building enduring wealth over time.
Right. So this deep dive has meticulously highlighted a crucial lesson drawn directly from the analysis. Don't get stuck between a low-return rock and a high-risk hard place. There are indeed intelligent, accessible choices available to you to grow your wealth strategically and, importantly, to generate income along the way.
Absolutely. And my final, maybe provocative thought for you to consider is this. The journey to becoming a truly savvy and successful investor is not, and never has been, about attempting to avoid all risk entirely. That's impossible and counterproductive. Such an endeavor would lead only to stagnation and the certain erosion of your wealth by inflation over time. Instead, it's fundamentally about understanding risk and then strategically managing it through informed choices. This includes leveraging powerful, often underutilized tools like writing covered calls, and diligently building consistent dividend income streams from high-quality businesses to build enduring, resilient wealth that works for you over time, year after year. It's about smart navigation and proactive decision-making, not fearful avoidance.
That's a truly powerful and actionable takeaway for our listeners, I think. We've comprehensively explored the foundational purpose of the stock market, meticulously deconstructed the illusion of safety inherent in fixed income investments, and revealed the genuine wealth creation potential achievable through a disciplined, rules-based approach to equity investing, complete with practical growth illustrations. We also delved deeply into addressing the inherent risk-return dilemma, and most importantly, highlighted empowering alternative strategies specifically for you, our income-focused investors. This deep dive was brought to you by FinBot Insights. If you found this discussion valuable and enlightening, please remember to click like and subscribe to our channel for more valuable content designed to empower your financial journey. Thank you for joining us.